She got on the straight and narrow, achieved a remarkable education, and is today one of the most consequential voices in monetary policy in our country. So that is Mary Daly. And suffice it to say, I've had the opportunity to work with her, and she is intelligent, diligent, and decisive. Mary, welcome to the Fisher Center. Let me introduce you to my colleagues who, like you, are serving the public. We provide housing, we provide offices, hospitality, retail, industrial space for the public. Money is an important part of our business. And we want to know how much it is and what the availability is and where the trends are that are going to affect that. So today's conversation really is an attempt to learn about what the cost of money is going to be, what the availability of money is going to be, and when we are going to achieve stability in the markets so that gives us the ability to have some sort of predictability and reliability on funding, because the markets are kind of confused in our business right now. So just to kick things off, let's talk about where the economy is today and what role inflation is, and just get it going. So welcome.
Sure.
A pleasure to have you here.
Well, let me first say that I'm just delighted to be here. I really enjoyed the dinner last night and so many of the conversations that I had there, and it's just a pleasure to be here. So thank you for inviting me, and thanks for the Fisher Center for hosting me. So let me just start with the headline. It may be surprising to you, inflation is too high. So that's the thing that is most important. It's the most resonant. Inflation is too high. And it's not only high in the United States, it's high across the globe. This is against a backdrop, and let me return to the United States. This is against a backdrop, though, of a solid economy. We have a very solid economy. The job market is historically strong. The consumer has been able to stay in the game despite the fact that inflation has been high. So we see some slowing in consumer spending, but not the kind of slowing in consumer spending you might anticipate, which just tells me people want to be out there, they want to engage in the economy. And so now we find ourselves raising rates, raising the interest rate to get the economy back on a sustainable path that has both price stability and full employment, but more importantly than anything, just lays the conditions for a long and durable expansion. So high inflation makes us very fragile, makes us very vulnerable to episodes of volatility, we get a shock, our inflation's already high, we can't really bear it as well. So that's why you hear the Fed officials again and again and again, Chair Powell in his press conferences, all of us as we go out and speak to people like yourself, saying we are resolute and united on the commitment to bring inflation down. Ultimately, that's a foundational variable for everything else we want to do. I feel confident that this is achievable, in part because we, again, have a really solid economy. We can name the hardships, but you can easily turn around and name the strengths that we are tightening into. And so that's what gives me the confidence that we can get this done. And I know everybody wants to know, is it a soft landing, a smooth landing? This is a landing, so let's take those words out for a minute. Let's talk about a landing that is one where everyone recognizes that the trade-offs of getting inflation down are worth the process we have to go through to get there. And I think that's where I hear more and more Americans saying, yes, please give us the relief, whether they're in business, small business, real estate. We all know that things are too frothy on the inflation side, and they really have to be pulled into a more sustainable place. But ultimately, the price stability goal we have is 2%. And there's no number you can calculate on inflation right now that's hitting 2%.
So the concept of neutral rate is important in your thinking.
It is.
And Milton Friedman famously said that monetary policy acts with lagging and variable effects. And let's talk about the neutral rate. And for the audience, why don't you define it?
Sure.
And go into where we are right now vis-a-vis that neutral rate. Neutral rate is the rate at which the interest rates are neither expansionary or contractionary. So tell us, but there are more dynamics besides that.
Absolutely. So we look at this concept. So the question that is really fundamental is, what's the rate that the funds rate would be set at, where we're neither stimulating the economy or tightening the economy? That's the sort of benchmark rate. And we came into the pandemic with that benchmark rate at about 2.5% in nominal terms. That was 2% inflation plus 0.5 real neutral rate. That's pretty low historically, and that's why you saw interest rate space across the globe be really, really low, is because 2.5 is, if that's your steady state rate, then anything above 2.5 is tightening, and anything below 2.5, and there's not a lot of room between 2.5 and 0. So that's where you hear people talk about the zero lower bound being a binding constraint, about how much policy we can support and provide. So those are the conditions we came in with. So now we find ourselves in a slightly different world. There's not a lot of evidence that the real neutral rate has moved up. Some would, we run lots of models in academic circles, in the Fed, and I looked at 11 models, just thinking about today, looked at 11 different models, and the estimates range from it's really negative, the real neutral rate, to it's really, really positive. So in other words, there's not a lot of, in my judgment, evidence to say we should change from that concept of the real neutral is probably 0.5. So that's a good benchmark. And if you look at the summary of economic projections that the Fed puts out, that's really the longer run sense of that.
How do you get there?
How do you get there? So you get there because you ask the question, basically the neutral rate of interest is just the price of money in a steady state economy. So it's when there's no shocks to the economy that are pushing it forward or pulling it back, what do you think the supply of funds and the demand for funds will deliver? And why is it low? Why is the neutral rate lower than it was, historically? Well, because two things are true. We have an aging population, and that produces a large amount of savings because people hang on to their money. And we have slow productivity growth relative to periods in history, which means there's less demand for investment. So low demand for investment and lots of savings pushes the price of money down. And that's just a demand and supply piece, and that's what's happening in the steady state. And people will also talk about a variety of other things that might be doing it, but if you just think about the global savings glut relative to the demand for projects, the demand for funding projects, then you can get to this idea. So there's really nothing to suggest that the population demographics have changed. The aging of the population is a global phenomena, and we are just at the beginnings of that. The tsunami, as people call it, of aging is upon us, and it's only going to continue to move through. So that's not going to be an important, that won't change. There's no evidence right now that productivity growth is surging in a fundamental way. It fluctuates from quarter to quarter, but there's no fundamental change. There might be down the road, but there's no sense of that. And global growth, with a slower growth in the labor force, because more and more older people are retiring and there's not new cohorts to take their place, then the slower labor force growth globally and slower, average productivity growth just means slower growth globally than we are used to seeing. So all of those factors mean a low neutral rate of interest, and that's how you get to this 0.5, and you stay kind of at 0.5. Now, I'm always open
but
to—
Mary, do the math. Do the math. What numbers are you using to get there?
To 0.5?
Right.
To 0.5, you really just take the amount of savings in the economy and the amount of demand for investment, and it equilibrates on a price of money of 0.5, an interest rate that's normal. And so you can do this a variety of ways. You can do it bottom up, top down, but that's how these models work.
And this is the real rate.
This is the real rate.
Got it.
So then the biggest question, though, is, most people don't think in real terms. I know investors do, but average people don't think in real terms, and the funds rate is not computed in real terms. We compute it in nominal terms to communicate about it. So, and this is the piece that's different. So let's just assume for the sake of the discussion that 0.5 is the real neutral rate of interest, and it didn't change very much for the reasons I said. What has changed is inflation, and inflation expectations even. So if you thought the nominal neutral coming into this was 2.5, 2% inflation target, and 0.5 real neutral, well, then you think it's a little bit higher. So there's a lot of ways people think about this, but here's how we think about it in San Francisco, and I think it's a really good benchmark, is you just look a year ahead at inflation expectations, longer run inflation expectations 1 year ahead. So you can compute longer run inflation expectation in 1 year ahead, 2 year ahead, 3 year ahead frequencies. And what you find is that they're hovering around between 2.5 and 3. So a good benchmark for the nominal neutral rate of interest right now is 0.5 plus 2.5, or if you want, there's always a range. This is not a variable with that capital T truth. This is an estimated concept rather than something we can observe. When Alex asks how you get there, it's based on models and data and it's estimates. But I think a really decent benchmark is, the nominal neutrals between 3 and 3.5 right now. So this is really important as we talked about the pace of tightening. So we've just got the interest rate up, the funds rate up to 3 to 3.25. So depending on where you want to be in that range of the neutral rate, 3 or 3.5, we are either at neutral and kind of just at neutral, or we're a little bit below neutral still. So essentially, we've been doing all this, what people have termed aggressive tightening, just to get up to neutral, the place where we're not stimulating the economy. Anything preceding that was adding stimulus to an economy that's already demonstrated it can function well on its own, and in fact is so high functioning it's producing too much inflation. So those are the metrics that I use, and you have to, one of the roles of good central banking is constant data dependence. We literally have to take an estimate of what we think it is and then watch all the time about whether our estimate is off and recalibrate it. And so some things that we would use to imagine, to think about whether we're missing on the neutral rate of interest is the economy slowing much more than we anticipated given where we are, and we haven't seen any evidence of that. So I still come in with the idea that 3%, a little bit over 3%, is probably a good estimate of the nominal neutral, and continued rate increases are going to be required if we're going to get ourselves into restrictive territory, which the inflation data clearly demonstrate that we need.
So how do you justify a 3% target when the PCE is over 6%?
It's really about inflation expectations. So if we just...
But still, we've gotten there, and it's stayed there, it's sticky. How do you justify it?
So by justify, let me just go through, this is the benchmark rate. That's not the settling rate. We need to be up higher. In terms of the actual funds rate, we have to be above the benchmark neutral rate in order to restrict the economy. So I want to separate those two things. The estimate of the neutral rate really comes off inflation expectations because realized inflation bounces around. The Fed Reserve bases a lot, our credibility holds the anchor on inflation expectations. That's what we want. If inflation expectations get de-anchored, and they just move one for one with realized inflation, well, then you're back into the 1970s, and that's a painful experience. We don't have that right now. If you look at the data on realized inflation, the 6% versus inflation expectations, medium and longer run inflation expectations have remained remarkably stable, despite the fact that we've got these really high prints on inflation.
How do you get that expectation number?
So there's three concepts that we use, and we use all of them. Another thing that is important, I think, for everybody to know is that if you're doing good central banking, you can't rely on a single data source. We always say we're data dependent, but we can't be data point dependent. That's a terrible way to think about policy because we need a dashboard of data. Janet Yellen actually famously started this idea of a dashboard of data. We've always been looking at a preponderance of evidence, I would call it, as in my training as a research economist. But the data dashboard, I think that really makes a lot of sense. So think about 3 ways we can look at inflation expectations. There's consumer surveys, the Michigan survey you might have heard of for consumers. There's also the New York Fed survey on consumer inflation expectations. And they're asking at the 1 year, short term, the medium term, and then 5 years out, what do you expect it to be? The second way we get it is from what I would call market-based inflation expectations. And those are really surveys of market participants and also trades they're making on futures, on tips, or inflation-protected securities. We can back out what they expect inflation to be based on how much money they're willing to pay for the protection. And if you look at all 3 of those, they start at different levels and things of that sort. But if you look at all 3 of those, what you see is the same pattern. Short-term inflation expectations go up because that's just being reactive to the data. You think gas is high today, gas will be high tomorrow. But if you look at the medium and longer run, you see that the realized inflation we have coming in has really not moved those medium and longer run inflation expectations in the same way. So that's why when I'm calculating the nominal neutral, I'm looking at those medium and longer run inflation expectations as opposed to just the short run, because I know the short run have all this stuff that we already know is in train. Gas prices, rental price inflation, which we know is starting to slow, but takes a while to fully move through the new leases are lower in price, but it takes a long time for new leases to be generated so that you get an average lease that's lower in value. So those are things that I would think are in train in the inflation data, and we don't want to be too reactive to those pieces of information, because you could easily find yourself over-tightening and then putting the economy into an unforced downturn. And unforced by meaning we don't need to be that down in order to restore price stability. So that's how I think about it. And so, again, as we, maybe I'll let you pull this further, but I would like to maybe talk about, Alex, the idea that there's really two stages of monetary policy movements. One is the stage we're just completing, which is get the rate up to neutral. And the second stage is how much do you have to tighten? How restrictive do we need to make policy to restore price stability?
Mm-hmm. So where is the medium and long term? What kind of time frame are you looking at?
So the medium and long term is really, the medium term is usually a 3-year window,
cool.
and then the longer run is a 5-year window. That doesn't, I wouldn't say, well, let's look at the summary of economic projections. I still think, oftentimes, and I've been quoted as saying this, so it won't be surprising to people to hear it, is that the summary of economic projections, this SEP, which the Federal Reserve puts out 4 times a year, and all FOMC participants participate in it, sometimes is only as good as the day that it is printed, because it is telling you where we think as of that day, and then the world changes. But I think in this case, the one we released in September is actually a fairly good indication of where things are looking. And if you look at the SEP and the projections, what you see is growth below trend in 23, GDP growth below trend, policy tightening that gets the rate up next year between 4.5 and 5%. That one policy tightening that raises and then holds, because we have to keep the rate at a tightening level in order to fully reestablish price stability. And you also see the unemployment rate rise to the mid-4s, and you see inflation come down at the end of 23 to around 3%. So you might ask, well, why isn't it 2%? And that's really because it takes time. I mean, we're printing it at very high numbers, and it takes time to bring it back down as these things work their way through, and we get to something closer to 2% at the end of 24. But I think that's a fairly good, from my vantage point, just speaking for myself, for me that still is a fairly good projection of what my expectation about the evolution of the economy will be. But all of that's predicated on there's not more additional shocks that we haven't seen yet that come out, and also that we continue to raise rates to fully get the economy into that into that restrictive stance, so that the economy can actually get back to a sustainable pace that has price stability and a good labor market and strong demand for goods and services.
So in the short term, you're about 3 percentage points above that long-term inflationary rate, right? 3.5%. So how do you deal with the issue of trying to contract things in the short term, knowing that long-term rate is where you're headed, so you don't overshoot?
Sure. So I think of it this way, and because I find it a helpful discipline. So if you look at the data, this has been a phenomenal period. There's several charts out there that talk about this, but it's really a phenomenal. It's been a phenomenal period. The forward guidance. So we have 3 tools, really, and I stack rank them in their effectiveness this way. We have the funds rate. That's a very effective tool. We have used it historically. We know how it works. It's reliably deployed. We have forward guidance, which we've used for quite a while, but it is gaining in power if you look at the data. And then we have our balance sheet policy. So forward guidance this time around has been very helpful, because remember in November of 2021, it becomes clear that the labor market is actually not just having a reopening strength, but it actually has real strength. It becomes clear that inflation is going to be more persistent and spread to sectors other than just the pandemic-related ones. It starts moving out of used cars and into core services, and so we see that. And so we've got this balance sheet that we are still purchasing, and we don't want to disrupt financial markets. So we start talking about we're going to quicken the pace of tapering our asset purchases, and be in position to start raising rates earlier than we had previously thought. Markets start repricing. If I had a chart, I'd show it to you, but financial conditions start to tighten right away. So then we roll forward to March. We raise the rate, we lift off 25 basis points, and mortgage interest rates go from under 3 to close to 5 in a period of 3 weeks. And that is a remarkable response that says that the monetary policy transmission mechanism from words and forward guidance to financial market conditions and tightening has become very quick. So that's a good thing. It means we're much more nimble than we have been in the past because we do have that forward guidance tool. But it is not the case that the rates to the economy has really changed very much. So if I was talking to the late, great Milton Friedman, you'd say it is long and variable lags. It might not be long and variable in the words to financial conditions, but it remains long and variable in the financial conditions to the economy. And you see that right now. So what then can happen? Well, if you keep tightening and tightening and tightening until you see literally the lagging variables that we're so interested in, what are the two most lagging variables in our portfolio of variables? Inflation and unemployment. They lag, they lag, they lag. So if we were going to tighten until those variables return to their steady state values, well, we could easily find ourselves, in all likelihood, would find ourselves in having over-tightened the economy so significantly because we didn't understand or we weren't paying attention to, the fact that this tightening is moving its way through the system. So rest assured, that's not how we think about it. That's not how I think about it. It's really about how much of this pent-up tightening that's already in the system is moving its way through the economy. And I would say a little bit of it, right? We're already seeing housing markets slow considerably. New leases on rentals are slowing. The consumer demand it's not slow, but it's not rising at the rapid pace. The labor market came off of a north of 300,000 a month job pace to something just over 200,000. So still pretty robust, but definitely slowing. So you see those things starting to take hold. But the question then is, do we need more? And in my judgment, more is needed because, even if we said, wow, there's a lot of slowing right now, 200,000 jobs, I'd just like to put it in this terms because it's easy to understand. 200,000 jobs is about 100,000 jobs more per month than we need just to hold unemployment steady, right? We're only bringing in, depending on the month, 100,000 new workers, or re-entering workers in the U.S. economy. So every time we run job growth, every time job growth prints faster than that, that's more pressure on the labor market. Wages go up, wage growth goes up, passes on to inflation, and you find yourself with things that are the dynamics that push inflation up. So I think more is needed to get us into restrictive territory. But as we approach what restrictive territory, and this is the second stage of policy. So the first stage of policy is raise the rate to get it up to neutral. And you can be fast. We know we shouldn't be accommodating, so let's be aggressive and get up there fast. The second stage of policy making, this is how I think of it. I should say all the remarks I make today are my own and do not necessarily reflect any other Federal Reserve official. So that's just the blanket, so then I can stop having the awkward interruption of myself. But I do want to share how I think about it. The way I think of this is that now we're in stage 2. And stage 2 of policy is we need to be thoughtful about how restrictive we need to be. And that means we have to be incredibly data dependent because we have to watch these incoming indicators. We have to make sure that we're doing everything in our power not to over-tighten. And we can't pull up too fast and say we're done because that's what we did in the 70s as a central bank. We stopped when it showed any signs of cooling, and then we found ourselves with a redoubling of inflation, which actually really solidified inflation expectations because that change before we're really done is very injurious to psychology. People think, oh, they're finished. My prices are still high and rising. I don't think they're going to really do this. I'm going to price this into my wage contracts. I'm going to price it into my rental contracts. And so we don't want that. So the risks are on both sides under-tightening, over-tightening. And that's why this data dependence and not necessarily, this is why you're starting to hear, and I've said this myself, the idea that we don't just keep going up at 75 basis point increments, we actually do a step down. And that doesn't mean step down as in pause and don't raise. It means step down into increments that are easier to manage, 50, 25 basis points, where you're still moving up, but you're doing it in a way that's not so aggressive that you don't have to find yourself in the awkward position. I think you all would agree with this. I know consumers agree with this. It's not a very good thing for most businesses, real estate in particular, and consumers, to raise rates really high only to reverse yourself because you found yourself over. That volatility, I mean, I just think of consumers, should I buy a house now or in 3 months when they might move? So I keep reassuring people that the optimal policy, the one that's historically delivered dividends and over time, is you raise and you hold. And you let the holding part of the policy, that tightening over a period of time, be a lot of the work. And I think, Alex, from your opening remarks, you did say, when will we get to stability? So it's, when will we get to the stability of the rate? And I think what you saw in the SEP, again, I'll reference that document since it's still relevant, is that you get there in 23 and then you hold for some period of time. And that's very different than what market participants were betting on. I don't know if you all saw the hump-shaped path, and that's obviously not what we have in the SEP, and certainly not something I would be supportive of in terms of optimal policy. You always have to be nimble. If conditions change, you change the policy. But as a policy projection, it's the raise and hold that has paid the dividends.
So let's just pause here for a moment to summarize. So your view is that the neutral rate is at 0.5%, and the real neutral, and that the inflation medium-term expectations of inflation are about 3, so neutral is about 3.5.
Yeah, and depending on the survey you use, they're either 2.5 or 3. So I think you could easily say the neutral rate, because it's, again, this is not precision estimating. So I would be comfortable between
around
3 and 3.5.
It's around
as
3,
the neutral.
3.5.
Yeah, I totally think that's a reasonable projection.
Fed funds today are at 3, 3.25.
Right.
So where do you need to get to, and the Fed funds rate to be at neutral today?
So at neutral, I think we're close to neutral, right? We're at 3.5, 3.25. So I think we're at or near neutral. But I think in terms of looking,
but that's a nominal rate.
That's a nominal rate.
And we're comparing against a real rate.
And real rates are, real rates are still, real rates are just slightly positive if you do that, right? Slightly positive real rate from a negative real rate. So if you think about slightly positive real rate, so forget about where we've been. Just ask yourself this simple question. If I told you that inflation was, in the monthly annualized 8%, and the unemployment rate was 3.5, and we had modestly positive real rates of interest, and since I asked, is that great policy? Most people would say no. We've got money is too easy to come by in a world where inflation's too high and the unemployment rates and labor market's already strong. So I think through that lens, because we don't look at the deltas, we don't look at the changes we've made over the last year, we instead look at the levels, then it's much easier to understand that more is needed. And so then from my perspective, I think getting next year to something between 4.5 and 5 is still a very reasonable estimate of where we'll need to go. But I say that with a double and triple underline that the key and core value of a central banker in this mode, in my prudent policy, is data dependence. Really being data dependent, really thoughtful, because there's as much concern of underdoing and overdoing, and I don't want to be in a situation personally where, because we were fast to get somewhere, we actually caused ourselves to have to either reverse or we realized it was a mistake. And I hear a lot of concern right now that we're just going to go for broke. But that's actually not how I think about policy at all. I think about policy as we're in stage 2. We need to really think hard about how restrictive we need to be. Clearly, at least in my view, clearly we need to be more restrictive than just barely positive real rates, because the economy is printing at very high inflation and we're tightening into a strong economy. The labor market is very strong right now.
So your view is that we are at neutral now,
Roughly.
Any future increases in the Fed funds rate will be restricted.
Right.
The question is how restrictive you have to get
Perfect.
in order to bring inflation under control.
That's that's a perfect summary.
Okay.
You can write all my summaries.
Okay. You mentioned the forces, the global forces that are deflationary, which are demographics, productivity, savings rates, and those things were what kept interest rates low for the past 15 years. Then we go into COVID, and we have labor force disruptions, we have supply chain issues, we have China shut down, and rates stay low. And we have to remember that in February of this year, the 10-year was at 175. So then we have the Ukraine on February 24th, and we have energy and food become factors, and things take off. And the Fed takes off, trying to get this under control. So the question before the House is, how do you, these are I don't want to use the word transitory, I'll use the word temporary. The question is how temporary they are going to be, the issues of labor force and supply chain and energy. These are temporary conditions that will go away over time, and those global forces will come back into play. So how do you, as you are being contractionary, how are you going to avoid having monetary policy outrun the inflationary factors that we recognize are temporary?
Sure. So that's a great question. So let me kind of unpack it into how I think about it. So just because it's a more durable language, it's one we've used through my whole career as an economist, is that there are, and any time you get an economic disruption, an economic shock, then you have cyclical factors that are playing out, and you have structural factors that still underlie the dynamics of the economy. So the structural factors are the ones that are always with us: demographics, productivity growth, all the things that we can think about. Labor force participation usually is highly structural. But there are these cyclical dynamics that also affect the outcomes we observe. And I want to take you back to the Great Recession. So in the Great Recession, the biggest debate we had in the aftermath of the Great Recession was whether all the workers who were let go and lost their jobs, if they were permanently scarred and they would literally never come back. And so there was a rush, if you will, to declare that the cyclical factors we were seeing were really being transformed into structural factors that would never change. And I saw this happening. I didn't think that was right. I actually wrote a couple of papers about why it might not be right. It turned out not to be right. But here's the lesson, that we all do this. We're human, right? So now here's what I hear, that globalization's over. Nobody's ever going to do this. Everybody's going to come home. We're going to go into protectionist mode. But people are entrepreneurial. It's really hard to think that they're going to abandon all comparative advantage opportunities and go back to single nations making everything for themselves. So I push back on that too. The question is, there's really two questions. How quickly will the cyclical dynamics that have been born out of the pandemic, and before the pandemic we had a trade war, we had a variety of other things going on, how quickly will those cyclical dynamics subside and the more structural dynamics take up? And then the second question is, what permanence from the big disruptions that we've seen, how permanent will be some of the things we've learned and some of the lessons? And so let's just take globalization, because I think it's a really easy one to think about, is will globalization be over? No. Do people who make goods now think that maybe they should have closer to home inventory management because the supply chain disruptions can be challenging in terms of delivery to customers? Yes. So putting those two things together, we've got several years where we're going to figure out what is near sourcing, how does that look different than outsourcing, and how do we think about this? So that's where you have to be. This is why data dependence is so important, because I actually don't know the answer for how long these cyclical forces will persist in affecting the outcomes that we observe. So if I knew, we could just make policy beautifully, we could write out all the rates and we'd have all the information, but we don't know. And so that's why I think the step down mode is important, that we step down in terms of just the pace of increases, not the increases. We have to increase the rate, but the pace of increases is, it's not just about there's vulnerabilities and fragilities and other things you have to think about, which is, I think, captivating much of the media. It's really about we are more uncertain now about where we will end than we were when we knew we needed to withdraw accommodation from the economy. And one of the uncertainties that you've highlighted, and it's a very important one, is when will the structural factors that have been pulling inflation down, that have been pulling the interest rate down, when will those things reemerge? And I think it's not as quick as we might have thought, because we're not the only country with high inflation. Other countries, every important country, every industrialized nation important in terms of economic economic size, is dealing with high inflation. So all the major players to the global economy are really struggling with high inflation. And many of them, Europe, just look at Europe, they're struggling with something the United States doesn't really have right now. They're struggling with high inflation and slowing growth for other reasons. We're tightening into a stronger economy, and I think that gives us a little bit of a benefit on the domestic side. But of course, we have to take into account global factors because they also affect our growth.
So when do you think that step-down process should begin?
Well, my own view is that it should at least be something we're considering at this point. But the data haven't been cooperating, right? I mean, if only I could make the data do what I want them to do, but they haven't been cooperating. And, I think about this a lot because as a policymaker, I care deeply about the lives and livelihoods of all Americans and how they can manage. And I know you all know this, but it always bears repeating. Inflation is a very regressive tax. If you're, median income and above, you have ways to manage. It's an inconvenience. It is annoying. It can disrupt some of your purchase plans and other things like that. But it's not the devastating trade-off that low and moderate income families have to make, because and just to level set it, when I speak to, low and moderate income families and communities in the district. So I have the 9 western states, and as Alex said, it's a vast environment with a vast amount of diversity. But here's something I hear no matter where I go. I could be in California, Idaho, Arizona, Nevada, Hawaii, Alaska. It doesn't matter where I'm at. I hear that I'm making trade-offs between rent, food, and gas. And I meet repeatedly people who say I have plentiful jobs, but I can't work as much as I'd like because I can't afford the gas to get to those locations. And remember, those people live pretty far away from job centers because of the cost of housing. So this is, for me, while I think stepping down is important, and at some point, for me, it's really challenging to step down right now when we have inflation printing so high, and we have, and core services inflation rising. And then we also have the unemployment rate at a historical low, 3.5%. So I'd like to make the distinction between when you start talking about it versus when you do it. And I think the time is now to start talking about stepping down. The time is now to start planning for stepping down. But that doesn't mean, and I'm going, in a week, I go and deliberate with my colleagues at the FOMC, and so I don't want to front run our deliberations because that's why we go, to deliberate with each other and think about this. But, there is a distinction, and I hope if I can convey this, I'd like everybody to hear this one thing. At this point, we have to think about where do we need to get the rate to, and we have to think about the path of getting it there. And so we might find ourselves, and the markets certainly have priced this in, with another 75 basis point increase. But I would really recommend people don't take that away as it's 75 forever, right? Because there is a point where you say, okay, we're getting nearer the terminal rate. By the terminal rate, I mean the rate will end at, and as we watch how this evolves, the raise and hold. As we get closer to that, then incremental steps that are not 75 basis point increments would be appropriate. So I see myself as thinking hard about the step down, but also recognizing we're not there yet in terms of where restrictive policy will have to be in order to deliver inflation that is, at 3% by next year.
So your colleagues are indicating like a 4.5% rate into 2023, right?
That's what the SEP said, and the SEP I think remains, as I said, good. If you looked at it was relatively split. If you looked at the participants, if you feel that you want to have a geeky Fed experience, you can look at that dot plot, and the dot plot shows.
Or read the minutes.
You can read the minutes. I mean, I'd look at the dot plot first and then go to the minutes, but you do.
By the way, the minutes are I find the minutes very interesting.
Me too. I'm glad somebody else is a
enjoy
fan of
reading.
them. I like them as well. I find them very interesting, and the dot plot.
Yeah.
So, just so you can share. I put the dot plot up, on my. So it's on my wall. Every time we do a new one, I put it up there because I'm thinking about it. I can't remember all the dots, so I put them up there. But I think it's useful. So what did it say though? So back to the serious component of this. What did it say? It said rates between 4.5% and 5% by the end of next year, and that is, I think, still a very good assessment of where we will need to go. And that's what I would call monetary policy strategy. That's our monetary policy path. That's our stance of policy. The piece about 75-50 is tactics. How do we get there? And tactics, as you all know from running businesses, strategy and tactics are different things. You want to keep your strategy, but then you decide on the tactics based on the incoming information, how quickly you can do it, what other factors are going on. And so when I'm deciding on the tactics, I'm thinking about, one, how much room do I have to make up to get to 4.5? And I'm also thinking about, what else do I need to be looking at? And one of the things I'm looking at is how much pent-up tightening we already have in the system, and we're seeing it start in the housing market and things, but I'm confident we're going to see continued step downs in some of these core variables, and I want to make sure we don't over-tighten just as much as I want to make sure we don't under-tighten.
So we're going to see another 150 to 200 basis point increases in the Fed funds rate over the course of the next 6 to 8 months.
Well, I wouldn't want to be so definitive. So I want to go back to that piece that it's funny, I say it a lot, but it never makes it into the summary, the data dependence part. So
yes.
So I think.
But based upon what you said,
so I think
people kind of got to anticipate that kind of.
I think a good starting point is look at the SEP, say interest rate going 4.5% to 5% by next year, end of next year, and so let me go 3 things: raise and hold. That's something to keep in mind, right? That this is you raise the interest rate and you hold it, because the holding part is also policy tightening. And that's really the first piece.
Well, we're going to be in restrictive monetary policy.
Yeah, we're going to be, that's
based
the whole
upon the
point
neutral
of
rate of 3.5,
Yeah.
you'll be restrictive.
Right.
So
And we'll stay there for a while.
Right.
Second thing is, right now, with all the things I'm looking at, I see 4.5 to 5 being a reasonable place to land. I do. But I want to hesitate to say that will definitely happen, because we have a lot of things going on. First of all, we have global economic situation that's quite
that was my next question.
erratic. And it's not just
The Liz Truss effect.
Yeah, well, let's move, if I may. I know it's the topic of the day, but if we can move away from the UK.
Well,
for a moment.
let me
Yeah,
just,
go ahead.
I just want to finish
Okay.
that one
Yes, of
paragraph. So if that's the case, the question really is about tactics. Is it 75, 50, 25, 25, 20? So, but the fact is that we ought to anticipate, these are all long-term thinkers in
Sure.
the room, that the tactics are really less important to us than the result.
Exactly.
So we should all kind of anticipate that kind of number.
Absolutely.
In the middle of next year. It's a question of how the Fed gets there and how long it stays there.
So let me add a better caveat than I had before. Here's a caveat that'll help you, I think. That's if we're thinking about the rates, and that's why I keep saying the SEP is a really good projection. And Chair Powell's going to go out and give another press conference after the next FOMC meeting. So here's how I see it. We are projecting those kinds of increases right now, and we're also data-dependent Fed. So we will be communicating with you if our views change. And you'll be able to adjust your own views based on those communications. So that means watching the press conference of the chair, looking at the SEP that comes out in December. That is where you would see any adjustments to our projections based on the incoming information we're getting. So both can be true. I think it's reasonable to have that as a benchmark, 4.5 to 5, and then it's in the markets have priced this in. 4.5 to 5 is about where futures markets are on the funds rate. And then the data dependence comes in, and you hopefully know our reaction function, but you also will get additional communications, right? This is the benefit of a very transparent Fed, a communicating one. You don't have to just hope and guess and then take the risk of being right or wrong. It's really that we'll continue to communicate as the data evolve. We'll talk through how we're thinking about them and what it means for our projections for policy.
So hopefully next year we'll see some softening in some of these temporary factors that are causing inflation, that the global factors of deflation begin to play in. The rate hits somewhere in the 4.5%, 5%, and then it begins to moderate to accommodate those the reduction in those temporary conditions. So let's get to the Liz Truss effect. So it used to be that the politicians dealt with fiscal policy and the central bankers dealt with monetary policy, and those were the two important players in creating our economy. Now we've got Mr. Market, who shows up in London and says, not so fast. Talk us through the global impacts of what happened in London, how you are attuned to that, and what should we be looking for in terms of the kind of boomerang effect that happens globally when some local incident occurs.
So let me just sort of broaden this conversation just a little bit, because while the UK is the thing that people have been focusing on in the news, this is a phenomena of how things get figured out that we've seen many times in our history. And here's the phenomena: is monetary policy is reacting to the economic conditions we have. In economics terms, we're a residual claimant on the economy, right? We see the conditions we have, and then we adjust policy to achieve sustainable growth, full employment, and price stability against those conditions. So that's our role. And we're independent, and we don't move to the changes in administrations or political needs. We just do that. That's the work. It's always the work. That's what the work that Congress gave us. So then the fiscal agents make decisions about, okay, what do we need to do other reliefs for inflation or other reliefs or things to spur investment, and that's what they do. And then the markets, and this is where the markets are always in play, the markets, because they're forward-looking and they're buying and selling all the time, they're deciding whether or not they think these interplays are going to be harmful or beneficial to the economy. And can we fund it? Can we not fund it? And that goes on all the time. And so I think it's not, although the situation in the UK, because it was so large, attracted a lot of attention, the dynamics of how this all works, I think, are very, we've seen them in different periods of history, and they're always there. So at this point, for me, I think of global conditions this way. It's much less about the UK. In fact, not thinking about those fiscal decisions or those fiscal issues or even what's happening there, because we're non-political. We don't think about those things. Here's what we think about. Here's what I think about. I think about what's happening in global tightening of financial conditions. So global tightening of financial conditions, the first and foremost effect on global tightening is the fact that we have synchronized tightening by central banks because of high inflation. So that's the first order piece of information. All central banks are tightening at the same time. That causes a considerable amplification effect on global financial conditions tightening, and we have to be very aware that synchronized tightening is something we have to take account of. So then if there's tightening, more tightening or less tightening because of other variations in countries' positions, so the war in Ukraine escalates, that looks bleak for the European winter, right? Because prices of commodities rise, and they've already got inflation that's too high. So they'll have real shortages, which is going to constrain growth, and it's going to push up inflation. So that's a bleak outlook if the war in Ukraine escalates further for the European economy. So that's a headwind against U.S. growth. So now we have a headwind against U.S. growth. We have global financial tightening that's more than just our tightening alone would be. And then we have the no COVID policy in China. And that's a policy that they seem they're going to hold on to pretty rigorously, but that really isn't great for supply chains. It hopefully is less disruptive than it has been because they don't have to lock down so much, but it still has ramifications for our growth. And demand. And so, you put all this together, and that's why I can't emphasize enough that we have to continue to watch the data, because we don't live in just the United States. We live in a global economy, and those global economic conditions are going to affect us. So that's what I'm really focused on, and if I stack rank the things that are important, it's global tightening, really thinking hard about what that means, what that looks like, how does it affect us. Then the second one is just the continued disruptions from the war in Ukraine and what that does to global commodity prices, food and energy being the number one, and then what does that do to the economies in Europe? And then the third is, what's happening in China with the zero COVID, and they also are trying to work through a property bubble or boom, I guess, and they're trying to work through other kinds of things themselves. So these are just a period, we're in a pretty tumultuous period where there's a lot of uncertainty. And so the uncertainty just means continue to act, but do so with a recognition that uncertainty is present, and we need to remain agile, data dependent, and frankly, quite thoughtful about the impact of our policies in this environment that's changing.
But the trust tantrum really highlighted the thinness of the market and the fragility of the market and how something like that can reverberate around the world. So let's transition for a moment over to our situation where we've got a balance sheet of just short of $9 trillion, and we're trimming back at $95 billion a month, and you're going to continue that for some time. And so we've got recognizing that $9 trillion is up from $900 billion in 2017. 2007 we were at $900 billion. Today we're at 8.9 trillion. And now currency has gone up to include about $2 trillion worth of that. So we've got about 6.5, 7 trillion. You've got some reserves that have to be in there, and you've got reverse repos that are in there. So, but we still have some serious contraction that's going to happen. Who is going to buy all of these mortgage-backed securities and treasuries, and at what price are they going to buy them? And how will you, most importantly, avoid crowding out that is going to seriously drive up rates?
So far, let's just do facts on the so far. So the New York Fed, the markets desk at the New York Fed monitors this hourly, daily. We talk about this in all of our deliberations to think about financial market functioning. And so far, our balance sheet policy hasn't disrupted financial market functioning. So that's where we are today. Second thing I want to say about this is that we're mindful of that always being a possibility, so we watch it and we think about it. And this is where the third thing I want to say comes into play. So there was a bit of confusion, I think, that came out of the discussions around the UK, and I just want to clear it up in the US. That there's we have balance sheet policies for two reasons. One is to stabilize financial markets. So think about March of 2020. Think about other times we've gone in. Treasury market dislocated in March of 2020. The Federal Reserve goes in because our job, that's the congressionally given job, is to assure that financial intermediation can continue, that we go in and stabilize market functioning to stabilize financial stability. This is critical in the Treasury market because of the important role that Treasuries play across the global financial system. So that is a job. Think of it as a technical job in my mind. We are meant to do this. We go in, we do it, and we stabilize. And that's what the UK did, the Bank of England did in their interventions. You're stabilizing financial markets so that they can trade. That is very different than quantitative easing or quantitative tightening. Those are policies meant to change the yield curve when we have hit the zero lower bound. So we hit the zero lower bound, we want the rates to be lower, so we're buying assets in those markets to get those rates lower, and that's a monetary policy initiative as opposed to a financial stability remedy. And so the important thing about this is we can do both. right? If we had a dislocation, and I don't see one right now, but if we had a dislocation, we could solve the dislocation without changing our stance of policy, because they're just different things. So we could continue to raise rates, we could continue to roll off parts of our balance sheet, we can continue to do things while we stabilize markets, and that's the key piece. The other thing about the balance sheet that often gets lost is that, in the discussions, is that the effects, economists, financial economists, monetary economists, analysts, by and large, the sense of the balance sheet is that the day we announce the path is the day everything's priced in. And then the rest of it's just mechanical. So only a change would cause that mechanical piece to unravel. So my own sense is that the tightening in financial conditions has been done when we announced the balance sheet and the plan for rolling it down, for shrinking it. That's been priced in. Depending on who you are, people estimate that's worth 1 or even 2 rate hikes. Hard to know, but it's another factor in why we need to be thoughtful as we continue to tighten. But say it's a rate hike. Well, that's already in there.
So you and I could go on forever.
Especially about the balance sheet.
Yeah,
I know you love to talk about the balance sheet.
I love the balance sheet.
Our star in the balance sheet.
Our star in the balance sheet.
I'm going to get him an
and the
Star
minutes in the
t-shirt.
minute. So, but I do want to give the audience an opportunity to ask some questions. If I could see a show of hands, please. Ron.
So, I am here?
No.
First,
Yeah.
not yet. Testing. Ready to go? Is there an oh, there you go.
There you are.
So first, thank you for being here. And perhaps more broadly, thank you for your service. I mean, the reason we're able to do what we do in this room, and the reason the U.S. economy has been so strong and so robust for so much and for so long, is because of the stability and transparency of our financial institutions. And you and your colleagues at the Fed just do a tremendous job to accomplish that. So thank you for that. By the way, having been under your thumb before, I am happy to be able to say we appreciate.
He was Bank of America. So.
Okay, great.
We
Excellent.
appreciate your scrutiny and what you've done.
There is a
for us.
regulatory component of the Fed as
Yes,
well.
there is.
Indeed.
So my question goes to the stress test. So yesterday we had a number of commercial real estate lenders talking about their willingness or lack of willingness to lend to real estate right now. And they kept going back to how the stress test administered by the Fed impacts banks' willingness to lend to certain sectors and impacts their willingness to lend specifically to real estate. So could you give us a little context around how you view the stress test, whether it's accomplishing what the Fed wants it to accomplish, and how we as users of capital might be able to react to how banks are willing to lend us money based on the stress test?
Sure. So the first thing to know about the stress tests and that is that the Federal Reserve System works on them, but the regulatory component of that is done by the Board of Governors, and now we have a new Vice Chair of Supervision, Michael Barr, and he, when Governor Quarles was there, he was focused on this. They're always, so this is the first area of reassurance I'd like to give you, they're always thinking about the impact, because the stress tests are meant to protect us from financial instabilities caused by banks not being well capitalized enough and then finding themselves, then we've got much more systemic problems than just the shock itself. So that's the purpose. And then there's always this calibration exercise of, are we doing it well? So I know Vice Chair Barr will be thinking about all of these things, but let me just speak for myself. Do I think it's working in the way we intended it to work? Well, let me talk about a lot of positives. We came into the pandemic with extraordinarily well-capitalized banks, and those extraordinarily well-capitalized banks were well prepared to lend through the pandemic, which is ultimately what we want your banks to do. Now, we did some some direction, basically, that said, don't buckle down on these folks, let them have a little more time, forbearance, et cetera. And those all were thoughtful, and I think helped the banks. I had the community bankers in this week from our district to talk about this, and they said, this was so helpful that there was this, we were well capitalized, but then there was some guidance from the supervisors that don't lock everything down when you want us out there intermediating loans and making sure that people can get from one point to another. So from that perspective, the stress tests, which are only applied to the big banks, that the GSIBs, that those I think have been effective at helping banks look at their own portfolios, get some continuity of how they look at their portfolios. So I think most people were aware that banks of all sizes regularly do scenario analysis, risk testing, et cetera, but the stress test put it in a formula that says it's going to be consistent across all banks. And I think that has been a benefit of getting banks making sure banks were well capitalized and prepared to serve as we come through the pandemic. So now as we look at the tightening, I mean, where do you know, I know I'm in a real estate conference, but think about where are we most vulnerable right now? I mean, commercial real estate is a highly vulnerable area. There's going to be some transformations that are required in commercial real estate with the change in how people want to work. So I'm an internal optimist. I think that probably would be consistent with all of you. But it doesn't mean we can just go back to where we were. You know, the idea that people are going to come to San Francisco, for instance, 5 days a week, you know, all the weeks of the year, just isn't right. So we're going to need some transformation there. And so I think that the stress tests and the lending and that scrutiny will be important. Plus, we're in a period where we need lending. We need the economy to slow. I mean, that's how monetary policy works. We raise the interest rate, lending slows, borrowing slows, and we get ourselves right-sized, getting demand back in line with supply. So I see these right now as positives rather than constraints, but I want to reassure you that, you know, the Vice Chair of Supervision and all the colleagues across the Fed system regularly ask themselves the question, we want the protection, but we don't want to clog up the financial system. And that's the challenge. If you don't allow innovation, you don't allow lending, you don't allow borrowing, well then you can, you know, restrain our rate of growth. If you don't think about how it's done and where the vulnerabilities are, then everybody suffers. And so finding that in the continuum is not a one-time process. It's a continuous experience. It's a continuous exercise.
So the clock has hit 9:30. Let's take one more quick question. Jim?
Thanks, and thanks for coming. It's great to hear the analysis. So you mentioned San Francisco, and while you have 9 states that you're responsible for and all these big issues, you are a chief executive of an important San Francisco organization, and I dare say probably the one most likely not to leave San Francisco. Of course, you never know. But I was just wondering if you could mention, in terms of your local responsibilities to the city, the region, the state, what's the role of the president of the Fed, and what concerns you that you'd like to address?
Sure. So one of the things that, and this is really about, this is how I approach the job. So when I got the job in October of 2018, we do have a head office in San Francisco, but I have branches in other locations. We have LA, Salt Lake, Phoenix, Seattle, Portland. Those are places that also would like us to be a presence. And we also, the Bay Area is big, and so Oakland and San Mateo, and not just the San Francisco area. So what we did is we committed to saying we need a bigger presence, we need a bigger team that focuses on local issues and our importance to the community. And actually we had a phrase, I developed this because I was trying to change people's mindset. It's, we want to move from being a bank that does community engagement and to a bank that is community engaged. And so what does that look like? Well, it means meeting with our local leaders. We opened an office of civic engagement. So we meet with local leaders, not just national leaders. We meet with the governors, the mayors, et cetera. Next year, one of the things we're working on is, you'd be surprised that, well, maybe you wouldn't be surprised. The mayors in every area that I go to are grappling at different scales, of course, with the same problems we grapple with in San Francisco. It's not different. Homelessness has risen. There's not enough homes for first-time home buyers. There's concerns about safety and cleanliness. When are we going to get people back? And will our city centers have the culture that they once had now that people want to stay out in the suburbs? What are we going to do? How are we going to grow? How are we going to attract? These are all issues that mayors across the district are grappling with. So one of the things we're going to be doing is starting a program where we bring mayors in, if they would like to, and bring their staffs into the Federal Reserve Bank of San Francisco and have people talk to each other about lessons learned. How do you grapple with this? What are the things? So that we can create networks. One of the things the Fed does best is convene. Because we don't have the tools to solve the problems that most cities and states face, but we definitely have the power of convening. And when we bring people in, public and private sector people, the the people from all these different areas, as diverse as they are, we find that they have similar problems, similar challenges, and they are idea generators then with each other and form a community. So I feel very strongly that one of the things we're redesigning our front lobby. If you happen to walk past our building right now, you'll notice the front's all in construction. We are fundamentally changing how we interact with the public. We met with a designer who's going to build the architecture out, and he said, what do you want? I said, I want everybody who walks past this to know that this is their Fed, that they belong here. This isn't some big government building where nobody can get in. This is your Fed, because we're honestly all we are is public servants. Everything we do, we have a banner at the front of our building. Our work serves every American and countless global citizens, and I think of that in the Bay Area, and also all the other states that we serve, all the other cities we serve. So that's the way I want it to be. I want to be present everywhere we are, and I want to make sure that we're bringing people everywhere we are together.
So you mentioned encouraging lending. From us to you, what encourages lending is stability.
Right.
When we know where stability is, there are a lot of bankers in this audience, and when they know there's stability, they will lend into that stable market at a price.
Right.
So we started the conversation with what is that price going to be and when are we going to see it? The answer is somewhere around 4.5%, somewhere around the middle of next year, where we'll start getting stability, barring any unusual circumstances that might come up. So hopefully that answered all of your questions. Mary, thank you very much.
Thank you.
Thank you very much.
Thank you.